Welcome to Dividend Strategy Decoded, a talk by Dr. Microlearning from December 2025. Over the next slides, we'll unpack why dividend ownership matters, how growing dividends protect purchasing power, and practical steps to build a resilient income portfolio. I'll guide you through sustainability checks, risk signals, tactical shifts, and concrete implementation steps so you can turn dividend theory into repeatable practice. This slide shows the power of dividend growth and ownership in 3 parts. Growing dividends can outpace inflation and preserve purchasing power over decades. Regular quarterly cash arrivals provide liquidity that calms investor emotions and reduces panic selling, and shifting from trading to owning reframes success in decades, not days, helping investors stay focused on long-term compounding and steady income. To ensure dividend sustainability, look for a conservative free cash flow payout, ideally under 70%, which leaves room to raise dividends even during downturns. Also, screen for operational strength like efficient cash conversion cycles, low maintenance capex, and pricing power, since dividends funded by operations are far more durable than payouts supported by debt or one-off asset sales. High yields can be a red flag, not a free lunch. Watch for yield warnings such as leverage spikes, shrinking margins, serial equity financed acquisitions, or industry disruption. The core principle is to treat extreme yield as a warning and verify coverage by modeling 3-year stressed cash flow scenarios to assess whether the company could sustain payouts under adverse conditions before you commit capital. The barbell approach pairs safety with growth by combining long-running dividend aristocrats and uprootion growers coming growers. Aristocrats offer proven track records and steady 6 to 10% annual hikes, while growth names with payout ratios near 40% provide future yield cost potential. Blending both fuses today's income stability with the prospect of higher yield over the next decade. When building a portfolio targeting 4 to 6% yield, diversify across income sectors like REITs, midstream pipelines, and telecoms, and allocate with clear target weights. Use quality screens such as debt to EBITDA below 3 times and investment to grade ratings, and manage concentration risk by capping single issuers around 5% so the portfolio can absorb cuts without a material income shock. Tactical allocation shifts respond to economic indicators. Overweight defensive utilities when PMI signals contraction and tilt to financials as rates rise to capture cyclically driven yield opportunities. Add 20 to 30% international exposure via dividend ETFs, focused on European energy and Asian telecoms, using currency-hedged options where useful to capture higher starting yields and incremental diversification benefits. Automate dividend reinvestment to compound payouts inside tax-advantaged accounts and maximize long-term growth. For active enhancement, consider selling 5% out-of money quarterly calls on core holdings to harvest an extra 2 to 3% in premium and recycle proceeds into more shares. This accepts a modest upside cap in exchange for incremental cash flow to reinvest. Implementation ties allocation and operations together. A practical target might be a dominant dividend growth sleeve complemented by a global high-yield ETF and a sector rotation sleeve. Operational rules should include auto-RE investing payouts, quarterly yield reviews versus the 10-year Treasury, an annual rebalance to target weights, and a 3-year cash wedge to mitigate forced selling during stress.